What is a business, really, underneath the logo and the jargon? A business is a machine for creating value. It takes inputs, your time, materials, rent, and turns them into something a customer wants more than the money they pay. Strip it all down and every company on earth obeys one identity: profit equals revenue minus cost. Picture a small coffee cart. You sell a cup for $4, and last month you sold 1,200 of them, that is $4,800 of revenue. Your beans, milk, cups, and rent cost $3,500. Revenue minus cost leaves $1,300 of profit. Simple, but notice the levers hiding inside: price, quantity, and cost. Nudge the price to $450 and profit jumps to $1,900. The whole craft of business lives inside those three levers. A business creates value, profit is just revenue minus cost, and price, quantity, and cost are your only levers. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. Would you rather have $1,000 today, or the same $1,000 a year from now? You take it today, and you would be right. Money in hand can be invested, it carries no risk of a broken promise, and inflation will not quietly shrink it. That is the time value of money. Push money forward and it grows. Future value equals present value times 1 plus the rate, raised to the number of periods. Put $40,000 in a plan paying 10% for 3 years, and it grows to $53,240, not $52,000, because you earn interest on your interest. Run it backwards and you get present value, tomorrow's dollars, shrunk to what they are worth today. Every is this worth it decision in this book starts right here. $1 today beats $1 tomorrow, always move money to the same date before you compare it. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. Why is an 11% loan almost never really 11%? The rate on the sign is the nominal rate. What you actually pay is the effective rate, and it is higher, because of compounding and fees. Say you borrow $35,000 at 11%, compounded quarterly. Each quarter you are charged 2.75%, and chaining 4 quarters gives an effective rate of 11.46%, already above the sticker. Now add a 0.8% setup fee, you sign for $35,000 but walk away with only $34,720, while owing interest on the full amount. Your true cost climbs to 12.36%. Always compare loans by their effective rate, fees included, never by the number on the sign. Compounding and fees push the real cost above the sticker rate, compare loans by their effective rate, not the headline. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. You've got cash and a way to spend it, but is the investment actually worth it? Answer it with numbers, not gut feel. Net present value discounts every future cash flow back to today and subtracts what you paid. If it is positive, the project creates value. Take a machine that costs $1,000 and returns $600 in year 1 and $600 in year 2, at a 10% cost of capital. Discounted, those two payments are worth $1,041 today. Subtract the $1,000 cost, and net present value is plus 41, so you buy it. The internal rate of return flips the question. It is the rate that makes net present value exactly zero, the project's own return. Accept when it beats your cost of capital, reject when it does not. Accept a project when its NPV is positive, when its own rate of return beats your cost of capital. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. How much do you have to sell before you stop losing money? It feels like a complicated question. It is not. Once you know the shape of your costs, you can find the exact answer on the back of a napkin. Take Maya's little bakery. Her fixed costs, rent, insurance, and one part-time baker, come to $5,500 every month, whether she sells one croissant or 10,000. She sells a croissant for $4. The flour, butter, and bag inside it cost $1.50. So each croissant leaves $2.50 behind to chip away at those fixed costs. That leftover is the contribution margin. Now the magic: divide fixed costs by contribution margin. 5,500 divided by 250 equals 2,200 croissants a month, about 85 a day. Below it she loses money, above it, every croissant is pure profit. Break-even equals fixed costs divided by the money each sale contributes. Run it before you sign a lease or make a hire. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. Why does a $500,000 machine not cost you $500,000 this year? Accounting spreads a big asset's cost over the years you use it. That is depreciation. And here is the twist founders miss: depreciation is not cash. No money leaves your account. But it is tax deductible, so it shrinks your tax bill, and that saving is real money. Take a machine costing $500,000, lasting 4 years, earning $300,000 a year with $50,000 in costs, taxed at 30%. Depreciation is $125,000 a year. Work through the tax, then add the depreciation back, because you never actually paid it, and each year throws off $212,500 in cash. Discount those 4 years, and the machine's net present value is plus $173,000. So you buy it. Depreciation isn't cash, but its tax shield is. Always add it back to find an asset's true cash flow. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. How do you make a smart bet on a future you can't see? You weigh the possibilities. Expected value is the average outcome, weighted by how likely each one is. Say you are thinking of running a weekend pop-up stall. It costs $10,000 to set up. If demand is high, a 60% chance, you make $40,000 in sales profit. If it is low, a 40% chance, only $5,000. Weight them: 0.6 times 40, plus 0.4 times 5, is $26,000 of expected gross. Subtract the $10,000 setup, and expected net profit is $16,000. Positive, so on average it is worth running. One warning: expected value ignores survival. If the worst case could sink your whole company, do not take the bet, however good the average looks. Score uncertain choices by expected value, but never take a bet whose worst case could end you. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. When you repay a loan, where does your money actually go each month? A loan has 2 parts: principal, what you still owe, and interest, the rent on it. In an equal payment loan you pay the same amount every period, but early on, most of it is interest, and only later does principal take over. Daniela borrows $100,000 for 10 years at 7%. The annuity formula gives a fixed payment of $14,237 a year. But watch, after 4 years of paying nearly $57,000, she has knocked only about $32,000 off the principal, the rest went to interest. That is what front-loaded interest looks like, and it is exactly why paying a little extra principal early saves so much over the life of the loan. Early loan payments are mostly interest. What you owe today equals the present value of the payments still left. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. Should you borrow the money, or sell a piece of your company? Debt is money you rent, cheaper, because interest is tax-deductible, but you must repay it no matter what. Equity is money you raise by selling ownership, no repayment, but a permanent partner who shares every future dollar. Equity always costs more, because owners take more risk and get no tax break. Most companies use both, so the real cost of their money is a blend, the weighted average cost of capital. With 60% equity costing 12.1%, and 40% debt at an after-tax 6%, the blended cost is 9.66%. That is your hurdle rate. Any new project must beat it, or it destroys value even when it looks profitable on the surface. Blend the cost of debt and equity into your WACC. Every new project must clear that hurdle to create value. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. What actually happens when a company goes public? A stock is a tradable slice of ownership, a bond is a tradable slice of a loan. They are born in the primary market, where cash flows into the company, and then trade in the secondary market, where investors just swap them among themselves. An initial public offering, an IPO, is mostly a primary market event. The company sells new shares to raise growth capital. How is the price set? Take the company's total value and divide by the number of shares. A software firm worth $300 million with 20 million shares prices at $15 each. Sell 5 million new shares, and $75 million flows into the business. The market you might think has nothing to do with you quietly sets the cost of your own equity. A share is tradable ownership, an IPO's price is simply company value divided by the number of shares. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. Where does the money to grow a startup actually come from? It usually arrives in stages, like rungs on a ladder. First you bootstrap, your own savings and revenue. Then friends and family. Then angel investors, wealthy individuals betting early. Then venture capital, funds writing bigger checks for bigger stakes. And finally, for a rare few, the public markets through an IPO. Every rung up gives you more capital, but you surrender more ownership and more control along the way. The art is not climbing as high as you can, it is raising only what you truly need, at the rung that fits your stage. Cheap, patient money early is worth far more than a giant check that quietly costs you the company. Each rung of the funding ladder brings more capital, and more dilution. Climb only as high as you must. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. You offer someone a $5,000 salary, so what does that hire actually cost you? There are 3 different numbers hiding in one job offer. Gross is what is on the contract, $5,000. Net is what lands in the employee's bank account after tax and their share of contributions, here, about $3,500. But the number that leaves your account is bigger than gross, because of employer-on costs, pension, social security, and benefits you pay on top. At a 25% on cost, $5,000 becomes $6,250. So the employee earns $5,000, takes home $3,500, and costs you $6,250. When you price your work or plan your runway, always use the true cost, never the paycheck. One job hides 3 numbers, always budget for the total employer cost, not the salary on the contract. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. What's the single most powerful force in building your retirement? It is not picking the perfect investment. It is time. When your savings earn a return, that return earns a return, and growth feeds on growth, that is compounding. Set aside $10,000 at age 30, earning 7%, and leave it untouched. By 65, 35 years later, it becomes about $106,800. You added nothing, compounding did the rest. But wait until 45, and the same 10,000 grows to only 38,000. Those 15 years you waited cost you nearly $70,000. For a founder starving their own retirement to feed the business, the lesson is blunt: the missing years can never be bought back. Compounding rewards time above all. Start small, start now, the early years can never be recovered. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. 3 financial statements look intimidating, but each answers one simple question. Did we make money? What do we own and owe? Where did the cash go? The income statement covers a period and ends in profit, revenue minus costs, step by step, down to net income. The balance sheet is a snapshot on one day, and it always obeys one unbreakable rule: assets equal liabilities plus equity. Everything you own was paid for with either borrowed money or the owner's money. There is no third source, which is why it always balances. The cash flow statement tracks the real money moving in and out, because profit on paper is not cash in the bank. Read all 3 together, and a business becomes very hard to fake. 3 statements, 3 questions, and the balance sheet always balances: assets equal liabilities plus equity. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. Why do profitable companies still go broke? Because profit is an opinion, but cash is a fact. Profit can count a sale you have not been paid for yet. You pay rent and salaries with cash, not with profit. 2 words rule your survival: burn and runway. Net burn is how much cash you lose each month. Runway is how long you last, cash in the bank divided by monthly burn. $50,000 in the bank, burning $10,000 a month, gives 5 months of runway, your countdown clock. And here is the classic trap: a growing company that pays its suppliers before its customers pay it can drain its cash even while every single sale is profitable. Watch runway weekly, not profit monthly. Profit is an opinion, cash is a fact. Know your runway, cash divided by burn, at all times. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. Most businesses that fail for money reasons fail the same handful of ways. Here is one that catches everyone: ignoring the time value of money. A partner offers you a choice: $100,000 today, or $110,000 in 2 years. The bigger number feels better. But discount it back at 8%, $110,000 in 2 years is worth only $94,300 today, less than the $100,000 on the table right now. So take the cash. The other classic traps are just as avoidable: confusing profit with cash, underpricing out of fear, signing fixed costs too early, and treating equity as if it were free. Every one of them is learnable, once you run the numbers before you act, not after. Never compare money at different dates at face value, discount it first, and the bigger offer often shrinks. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. How do you turn "I want to sell a healthier dessert" into a decision you can act on? With a business plan, and it is for you first, a no-cost stress test before you risk real money. The method is 3 steps: collect the data, turn it into numbers, then write it up. Take Frost Green, a plant-based dessert startup. $50,000 to open the doors. Fixed costs of $8,500 a month. Each cup sells for $4 and costs $1.50 to make, so it contributes $2.50. Divide fixed costs by that contribution, 8,500, over 250, and you get a break-even of 3,400 cups a month, about 140 a day. Now the honest question is operational, not financial. Can you actually make and sell that many? A business plan is a stress test for you first. Collect the data, turn it into numbers, and find your break-even. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. Markup and margin sound the same, and mixing them up can quietly wreck your profit. They measure the same profit against different bases. Say a product costs you $60 and you sell it for $100. Your profit is $40. Markup measures that 40 against your cost. 40 over 60 is a 67% markup. Margin measures the same 40 against the price. 40 over 100 is a 40% margin. Same $40, two very different percentages, and founders who set a 40% markup thinking they are getting a 40% margin quietly give away profit on every single sale. Price is the most powerful lever you have. A small change flows straight to the bottom line, so set it deliberately, never out of fear. Markup is measured on cost, margin on price, same profit, different base, never confuse the two. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. Your books say you made $10,000 in profit, so why is the bank account empty? Because profit and cash are not the same thing. Imagine you buy $40,000 of inventory, paid now, and sell it for $50,000, but your customer pays 30 days later. On paper, $10,000 of profit, a healthy 20% margin. But in month 1, $40,000 went out and nothing came in, a cash flow of minus $40,000. If you started with less than that, you fail in month 1 despite every sale being a winner. And the faster you grow, buying more inventory each month, the bigger that hole gets. The gap between paying out and getting paid is called the cash conversion cycle, and managing it is half of real-world finance. Profit can rise while cash falls. The gap between paying out and getting paid is where growing firms die. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more. You can't watch everything, so which few numbers actually tell you how the business is doing? Raw numbers mean little until you turn them into ratios you can track over time and against rivals. A handful go a long way. Gross margin, what is left after the direct cost of what you sold. Net margin, cents of profit per dollar of sales. 7.5 cents is normal for a coffee shop, but a software firm would be in trouble at that. Return on equity, how hard the owner's money is working. And the current ratio, can you cover your near-term bills? Above 1 means yes. One number alone means little. It is the trend over time, and the comparison to your peers, that tells the real story. A few ratios, margin, return on equity, current ratio, beat a page of raw numbers. Watch the trend, not the value. Want the full method, with work numbers? It is all in my book, How a Business Works. Subscribe to All About Economics with Michael for more.